Good morning, ladies and gentlemen. Hi. Wow. What a crowd. Can I hear a good hi from everyone? Good morning, everyone. Hi. All right, I got the spirit, right? So, in fact, right now, it's what we call a fireside chat, all right? Fireside chat means feel free to ask. I want you all to log into to the Slido and ask away, ask all those questions that you want to know. Now, today, before I start introducing this session, allow me to introduce three panelists for today, right? And number one, we have Mr. Jerry Lee Chi-Yong, Portfolio Managers of FSMOne Managed Portfolio. Second panelist, we have Mr. Chai Kin On, Stocks and ETF Manager. You guys are so biased. You all are cheering for Kin On. All right, to the last one, I have Mr. Tan Tao Hong, Global Fixed Income Manager of FSMOne Malaysia. All right, so I get it, right? Y'all never clap for me. Y'all clap the loudest for Tao Hong this morning. What about Jerry? Anyone? Woo! Okay, now, I think Terence got y'all onboarded to a flight, right? Don't worry, it's a safe flight. You will be as safe as what you have saw in Japan one, okay? Everyone will be safe. Don't worry about it. It's like your investments, you will be guided, all right? No matter what. Now, today, this fireside chat, I want you to be able to sit back and relax because, to be honest, this is the very first time that we got 3 internal speakers to be on stage. Now, today's session, all right, is called Threading the Needle. What do I mean by that? It's like trying to thread a needle through a hole. It's very difficult. So which is the main vehicle that would drive you to your own investment destination? All right, you have different sports car here. We have Jerry, sport car number 1. Mr. Chai Kin On, sport car number 2. And Tao Hong, you all cheered the loudest, right? Sport car number 3. All right, to your investment destination, how do you get it? All right, how do you get it to there? So offering fresh perspectives, they are representing each of their very respective products, diverse yet interconnected. All right? So let me move on to the first slide of today. Now, thank you, Kevin. You have introduced the usage of this disclaimer, so I will not focus on it. To the next slide. Now, today, we have 3 main focus of key areas to be discussed about. Number 1, it's about active versus passive management. All right, I believe recently there are a lot of topics surrounding this. ETF is getting more and more popular in the markets. All right, then moving into the second one, who is your greatest enemy when it comes to investments? Joe Biden, Xi Jinping, definitely not our Prime Minister Anwar Ibrahim. It's actually us, ourselves, our own emotions that affect us when it comes to making investment decisions. And last but not least, value orientation. Now, we are all paying fees when it comes to investments. The fees that we have paid, what are the values that they have created? All right? So today, before I start, anyone know any first aid knowledge? First aid kit? Because I'm going to get the best out of them from these 3 sport cars, and they're going to fight for your capital. For you to entrust with them in 2024, which are the vehicle, which are the sports car to drive to your investment destination. Now, to the first slide. Let's talk about active versus passive management. All right? Now, just now I have mentioned, nowadays ETF is getting more and more popular. Today, when I want to invest into probably US markets or even into European markets or into EV cars, I will try to look into which is the right ETFs for me to go into. All right? So today, we have these 3 sports cars on the stage. Now, I'll just start off from, probably King On first. Would you be able to share with us? I mean, since ETF is gaining more and more popularity nowadays, how do you see it?
Well, I think a comparison between ETF versus UT, whether which is better, I don't think there's an explicit answer to this. Basically, there are 3 perspectives. I think number 1, which is active trading, ETF, you can trade along the trading hours versus UT, there's only one day, one price. So having said that, if an ETF goes up, in a single days, maybe at a peak 120, and eventually came back down 100. So if it's, apple to apple comparison, UT would probably NAV at 100, whereas ETF is 120. So having said that, active trading allowed, over the exchange allowed the client to actually take profits, during the intraday at a high price, and then eventually, maybe re-enter again when it comes down, right? So that's number one. But also bear in mind is that during active trading, there will be a chances where, client or investors will be buying into premium or discount, because the fair value versus the fair value of the underlying ETF versus the transacted price could be different, especially in illiquid markets. But for US and Hong Kong, markets are fairly liquid in the sense. I think secondly, which is the total ownership cost of an ETF compared to UT. So I think generally ETF has a lower total ownership cost simply because its format of being transacted over the exchange. And then I think secondly is that a passive investment strategy. I think lastly is that why ETF is better than UT is because ETF sort of allow clients to gain exposure and construct a portfolio into a very niche market. For example, there's 3,800 ETF available on FSMOne stocks and ETF platform. Ranging from thematic ideas, synthetic, as well as alternative investment. From gaining exposure to agriculture, specific EV, hedge fund, or even Bitcoin, as well as, commodities, precious metal. Yeah, so I think with these three perspectives, I think, ETF, generally are better in that perspective.
All right,
Yeah.
so ETFs is more towards a more transparent investment vehicle.
Yes.
But you got to trade it, right? You got to manage your own entry point of time, right?
Yeah.
So this is about investors themselves. They will need to do it themselves, DIY experience, right? Okay. Now, just now when you say the word better, Jerry was smirking. Like, I don't think he agrees with that. Jerry, what do you think? Unit trust funds versus ETFs.
Yeah, I think I echo what Kinon had mentioned, because if you think about answering which is better, ETF or unit trust fund, we don't have a straightforward answer to this. Because if you think from a perspective of where I am investing in, you think about when I'm investing into US, and if you think about US market, which is a developed market and most efficient markets in the world. So in this kind of efficient market, of course, there is little room for fund managers to really outperform the index. That's why you will see most of the developed market fund managers that tend to on par with the index or slightly underperform the index. On a long-term perspective, it's really rare for fund managers to consistently outperform in developed markets. But take a step back. When we look at emerging markets, when we look at Asia ex Japan, or particularly Malaysia equity markets, we will be buying into your KLCI. If you look at where KLCI at 10 years ago compared to where KLCI at today, they're probably at the same level or even slightly lower. So in this kind of inefficient markets, we won't tend to go for ETF. We'll try to go for actively managed unit trust fund. These are the markets where fund managers has the room to really outperform and deliver alphas to investors. So I think when it comes to constructing a portfolio, it got to be really think about which markets I'm allocating my capital. If today I'm allocating my capital into most of the developed market, most of the efficient market, yes, I can go for ETF. Or like what Kinon mentioned just now, some of the niche market, like for example, I want to invest into EV. But I look into unit trust space, none of these unit trust funds focus solely on EV. I want to invest into China semicon, but I couldn't find any unit trust fund that invests into purely China semicon. So then you can actually go for ETF to get this kind of exposure. But when it comes to emerging markets, Asia ex Japan, even Japanese equity markets or Malaysia equity market, I think just now Kevin's side have shown some data. In Asia ex Japan markets, over a 5 years period, Asia ex Japan fund managers, they tend to outperform index by more than 20% Malaysia fund managers tend to outperform your KLCI by more than 40-50%. So those are the market you want to go for, the actively managed unit trust fund. So like a straightforward answer is that you can't really say where should I go for, ETF or unit trust fund, but depending on markets you are investing in, efficient market, yes, you can go for ETF. But most of these inefficient market and also Asia and emerging market, it's better to go for your unit trust fund.
I see. So the keyword here is depending on what are you buying into, where are you buying into. Am I right to say that? Efficient markets, ETFs.
Yes.
Less efficient markets, that would be unit trust funds managers who are actively managing their portfolios.
Yep, you're right.
All right, okay, cool. Now, we talk a lot about equity. Just now, Kevin also mentioned one thing, all right? US government bonds or US treasuries as the safest assets right now is fetching a yield about high 3 or close to 4% of returns. We talk about ETFs and also unit trust fund. Tao Hong, is there any ETFs available in the markets that can give you this kind of returns? I'm just curious.
First of all, Happy New Year, everybody.
Sport car number 3, say hi.
And as much as I like sports car, in my world of bonds, I would like to describe our vehicle as a classic Beetle, right? It's much more sturdy, it's much
Boring.
more classic. It's boring.
No.
I love the word boring, right? And
Yes.
I'll leave a little bit of explanation why I love the word boring for fixed income later. But when it comes to active management and passive management, I think I want to introduce one word. And this one word is very important to all of our investors here. And the word is intent, right? What are you intending to do when you're doing passive management? What are you intending to do when you're doing active management? As much as I hate to give your capital to them, right? Let's start with passive management. Right? Passive management, when it comes to bonds, is very simple, just one word, income. Right? All of our investors here who are already invested in bonds directly with me or through the fixed income unit trust vehicles, you know income is something that bonds gives you quite consistently. Right? Every 6 months down the road, you can plan your income. Every 6 months down the road, you can know how much is coming into your cash account quite reasonably, confidently. So when you are investing in passive mindset, collect your bonds, right? Collect your cash-generating instruments. Collect your direct bonds. That will help you form your foundation in terms of passive management. But when it comes to active management, I have to give the hats over, right? Some vehicles are just better at doing active management job. Let me give you an example. ETF, Sherman was asking, right? In the ETF world, it's much more defined. And when we say defined, it means that these ETFs can actually express your intent better. And I'll give you an example. If you want to bet on the treasury yields coming down or the treasury bonds prices going up, there are ETFs vehicle for you to do that. There are 20 years long duration ETF, treasury ETFs for you to do that. And if you want specific ETF that gives you exposure into distressed non-investment grade bonds, there are options for you also. So ETFs, unit trusts, they are taking care of you in the active side. So for us, both, right? You have to have both. Form your foundations with your income and, what we like to say in the market, pick up your returns through your active vehicles. Back to you.
All right, thank you, Tao Hong. You all know who's the most hard sell one on the stage already, right? Longest answer. But he mentioned one very good point is, what is your intention to do with active management or being passively managed for your portfolios, right? I think that's very, very important. So we're not saying that you only need to have one vehicle. It's always good to have two cars, right? You have weekdays car and weekend car, right? All right, anyone got an EV already? Very hard to charge, right? Just jokes aside. So this is our Act 1 about active versus passive management, all right? Now let's move on to the second act. So this was what I prepared because right now, market was talking about the renaissance of ETFs, and we have heard from 3 experts. If you want ETFs, there are specific ones. be it a leveraged one, be it a traditional one, all right, focusing into the index or focusing into one sectors, you have or even be actively managed when it comes to investing into certain markets like Malaysia, Asia, Japan, and most importantly, find out what you want to do first, like what Ta Hong has advised. All right? Now, to the second act. All right? Second act is common investment behavior. Now, this is a renowned investor by Benjamin Graham saying that now the biggest enemy in your investment journey is you yourself, is us. Because we are all human. It's okay to make mistakes, see, don't get me wrong. But when emotions kicks in, right? For example, when 2022 market drops all the way down, technology was dropping negative 40%, everyone would have been panicking. What should I do for it? All right? So, but don't forget, all these emotions is the one that so-called affects your investment decisions. Now, if you were to move on to the next slide, you see this is the roller coaster of emotions. When you do investments, you tend to find a lot of data to confirm what you have done. All right? And when things happen, maybe this is too early for me to buy. But a lot of people forget themselves that they have gotten in a very, very peak period. When it drops all the way down, one conclusion, this investment is a scam. It's always emotion, right? All right. But don't worry, like I said, we have 3 sports cars here. Okay. So I have prepared some questions to ask them, all right? To put it this way. Now, again, before I move on, this slide is showing you when you are trying to time the markets, your returns is not guaranteed. Meaning to say, even if you do market timing, that will not eventually fetch you to where you want to be at the end of the day. All right? Now, I wanted to start off probably from Jerry first. I think when it comes to common investment behavior, you are a portfolio manager. What is the role your portfolio will be able to do in helping them shaping their investment journey throughout the way?
Yeah, okay. Maybe I share a little bit from one of the conversation that I had with one of the friends outside just now, this morning. We're actually talking about, if you look at the markets throughout the past 4 years to 5 years, we have been in a roller coaster move. We started off with 2018, you have a trade war between US and China. If you look at that point in time, China market dropped close to about 20-ish to 30%. US market also dropped close to 20%. But subsequently, towards the end of 2018, everyone is still pessimistic. Subsequently, in 2019, market delivered strong returns. I think on January, equity market up by close to 20%. Then we enter into 2020, we have COVID that hit. For the first 3 months, market down more than 20%, but subsequently, we ended the year with a positive gains. 2021, US was doing well, but China and Asia, Japan was doing quite badly. And moving into 2022 and 2023, even 2023, we have been seeing roller coaster ride across the global equity market. So I think one of the key points that we have learned throughout the years is that when it comes to investing, we also try to match back with our data, our sales data. We notice that when the market sentiment is good, meaning to say that when the market is doing very well, we tend to have huge inflow. And this is exactly what you mentioned just now, Truman, your emotional factors that kicks in. Because as a human being, our decision tend to be driven by emotion. When things looks great, when the outlook looks great, we tend to be greedy. But we know when things looks great means things are expensive. But ended up, people tend to buy at a high price. And subsequently, when things came down, everyone started to be panicked. Because like you mentioned, I bought tech in early of 2022, I've suffered a 50% loss. With a 50% losses in my portfolio, how dare am I to top up, to average down? And don't even mention that if I have a full portfolio that concentrated in technology. So that's kind of an emotion actually affecting investors throughout the investment journey. As a professionals, we don't say that we get it right every time. To be very honest, we make some wrong calls along the years. For example, I want to highlight in 2022, we actually overweight Asian high yield, overweight China equity. Those are the wrong calls that we make. But if you look at it, the position that we are taking is that when we make a wrong call, we try to learn from there. We try to correct our mistake. And the most important thing is, with a team of professionals, we have to really justify the reason why we enter into this market, why we overweight certain markets to a team of investment committee, as compared to individual investor. Today, I think US can buy, let's buy US. Tomorrow, I think it's time to buy semicon, let's buy semicon. So all these decisions are driven by emotion. But a team of professionals that manage your money, your decision will be more reasonable, will be more logical. We tend to justify it from the fundamentals perspective. I don't mean that this decision made by the professionals will always be right and always be the best scenario for investor, but at least it's consistent and disciplined over the time.
I see. All right. So you talk about emotions because every time it's not right now buying US feels good, right? Anyone wants to buy China? The past 2 years was a bad. Oh, there are still people raising hand. Good. Long-term investments, huh? But keep it in the portfolio way, okay? Now, you have heard from Jerry that Jerry talked about his game already. Answers was longer. Now, Kinon, as a stock and ETF manager, will be able to share with us over the past 2 to 3 years since we have started our stocks and ETF business over these few years, what are the patterns that you saw? How do investors normally behave during a market downturn or when market was doing good?
Yep. I think investing in a portfolio versus doing self-trading in stocks and ETF is relatively different. Investors tend to have a different mindset, But after taking care of the stocks and ETF business, I learned that when there's a bear market, there will be a net sell position almost every single time. Especially market is coming down.
So meaning when market coming down, everyone sell?
Correct. Meaning everyone is taking losses.
Okay.
Because they think, oh, I made a wrong bet. It's time to go, right? Then when the market goes up, they say, oh, ini kali lah, Then they've been chasing the market, right? These are the things. And then I think these are just a very general, mindset or behavior of individuals, investors that when they engage in self-trading. So I think another point is that because, we're looking at some of these statistics because we also have certain larger clients, which are corporate on Insti, we will see a very different, behavior that they portray.
Stronger holding power.
Not just stronger holding power, they tend to top up when the market goes down.
Okay.
They are very happy when sometimes they call me, hey, Kinon, top up another 10 million for my account. I want to buy later in the noon when the market open.
Provided you have 10 million in your cash account right now. Huh?
Okay, we are just applying
Carry
the context. You have 10, 100,000, that will be 100,000. It's just you will see a very different pattern between a corporate client or Insti client versus individual retail investors. Yeah. Then I think another perspective is that, especially last year, 2022, I think all retail investors tend to focus too much on headline. Having said that, Fed today, hawkish, cannot lah, or maybe they say, or they think that, general market was doing better, because of the, interest rate is going up, or that means the economy is still strong, continue buying, And I think this resulted that client eventually forgotten about the fundamental, they don't care about fundamental of the economy, of the stocks, So that's the thing that, we see, a behavior from the retail investors.
I see.
Yeah.
So plenty of clients will be affected by what they are seeing in their phones. The Edge, CNBC, Bloomberg, right?
Correct.
Now, may I remind you, these are all very eye-catching headlines or titles. When we act upon it, right, you forgot about your own risk profiles. You forgot about your investment horizon. Oh, now Bloomberg tells me there is a sure win strategy emerged for China. I will just go and buy it. But I forgot that I have 40% in my portfolio for China right now. That's very dangerous, isn't it?
Yeah, correct. And I also always receive, after I taking care of the stock and ETF business, they always think I'm the tycoon at the back. Say, bro, got any good counter or not? Introduce. Then I say, if I got, I don't sit here work already lah. I just go borrow money and leverage and buy, right? Yeah, so I think one advice to all retail investors is not to always gauge on rumors, probably there's a saying, buy on rumors, sell on news.
Okay.
So I think a lot of retail investors still believe, oh, this guy tell me one, confirm on one. Or this guy in the industry one, he don't cheat me one. You know, I heard some, in fact, it's my own family member, just my relative. They know some of the dato, you know, dato lah, you know, in the market, and they say, oh, this dato say, this one continue fly. I cannot tell what counter is that lah, you know, but ended up, it fly lah, but fly down lah, you know. Until now, it's almost worthless. You know,
Okay.
so retail investors don't fall into that.
Kin On here is a very good sport car, very on the ground, right? The way he speaks, right? But the thing is, do not buy or sell based on rumors. Do your research. Read
Focus
our
on
articles.
fundamental, yeah.
Approach your advisors or your CIS, right? Isn't it? Now, Kin On, Jerry shared a fair bit. Now, Zhao Hong, just now you talk about ETFs, right? You're helping sport car number 2 to do his sales. What about OTC bonds? What do you think about it? How does OTC bonds will be able to shape investment behavior?
When it comes to emotions, and specifically with direct bonds investing, I'll give you 3 words. Just now I gave you 1 word, intent. The next 3 words I'll give you is leave it alone. Right?
No. You say
alone.
leave me alone or leave it alone.
Leave it alone.
Leave it alone. Okay, all right.
And, and a lot of times, what we hear from Kenon, what we hear from Jerry is that we tend to be overconfident ourselves, and we tend to overtrade ourselves, right? And sometimes we over-convince ourselves by, you know, listening to news and articles that confirm our biases. These are all natural. We are all human beings. But back to direct bonds investing, I think I'm the only one on stage here that can say that when you buy into direct bonds, you have a certainty of the returns that you're going to get. Right? Can you agree with me? Some of these investors that have bought into direct bonds, when you buy into bonds, what is it called? It is called fixed income. It is called fixed income for a reason. When you pay the price, you know exactly what is the net yield or the net return that you are getting from this investment for the next couple of years or up to the maturity of the bond. So this is leaving it alone, I would say. Right? When you buy into it, you hold it, next 6 months, you get to enjoy the cash flow. Up until the maturity, you get back the principal. That's it. Leave it. Right? A lot of our clients who left it alone I think are smiling in the crowd. And probably it could be the only bright spot in your portfolio. I hope not, but right? That's the reason why you got to have your foundations right. You got to collect your bonds that are giving you cash flow and leave it alone. Okay?
Second word. You say you want to introduce 3 words, right?
Leave it alone, 3 words.
Okay, all right. Leave it alone. Okay, got it. Okay, so Zhao Hong was saying that leave it alone. Let the OTC bond does its own work, right? Now, I know you all love my sport car number 2, but the very on the ground one. I'm gonna give him one more question. Now, if I wanted to invest for the long term, hassle-free, all right, but I want to so-called to be very close to the markets, is that a way to do so?
I think the direct, straightforward way.
What do you recommend?
Which is invest into an ETF that tracks certain index. That's
right.
straightforward, right? I guess everybody know. And that's where, all of, the UT fund managers would tend to want to say, oh, I want to beat certain indexes. But of course, when we wanted to track an index, it's relatively easy. Just buy into an ETF that tracks an index. Because it's a great idea, because over the years, as you can see, for the past 20 years, it's an uptrend for most of the ETF, like S&P and Dow Jones, actually, over the past 20 years has gained, for S&P, gained over 400%, whereas Dow Jones have gained over 350% over the past 20 years. So I think this is the reason why also FSMOne, we have, design and offer regular saving plans into ETF. Currently, we are covering about 120 ETF in Hong Kong exchange as well as US. Yeah. So I think regular saving plans allow our clients to invest, minimum of 100 ringgit, based on the frequency that the client wants into an ETF. So I think over maybe 5 years or 10 years down the road, it should be a significant sums of monies. Yeah.
I see. So in order to do it over the long term, and the investment barrier is as low as 100 ringgit. You
Yes.
can start to choose from 120 ETFs that covers US and also the Hong Kong markets.
Yeah.
What about Malaysian markets?
You know, like what Jerry mentioned also, I think the cold hard fact is that the ETF in Malaysia are relatively illiquid or inefficient in a sense. So, you know, when we onboarded certain ETF on a regular saving plan, we don't just say, you know, okay lah, this will be the one, this will be the one. We basically cherry pick them, you know, based on the outlook, based on the fund size, based on the tracking error. Then we onboard it into regular saving plan. That's the reason why, you know, Malaysia ETF is not on there.
I see. Yeah. Okay, all right. Thank you so much. Now let's move on to the third act, all right? We all pay fees, right, when it comes to investments. You need to pay to drive sports cars, right? Am I right to say that? Now, I think I have prepared a small surprise for my sport car number 1 today, this morning. I think I would say let's see into this particular slide is the performance numbers. Now, this is where we ask Jerry about how did they perform last year and over the past few years. And now, Jerry, I mean, as evident in the slides, right? 2023 was a good year, was a very decent year. Portfolio did okay. But if there are investors who are still looking at losses because they invest at the peak at 2021 or 2022, what is your advice? And how do you justify all these volatility over the years?
Yeah, of course. I think if you look at performance itself, right, throughout, like for example, you look at the calendar year's performance, throughout the past 7 years, since 2017 to 2023. If you look at throughout the 7 years, we have registered losses in 2 years, 2018 and also 2022. And of course, I think until today, we don't deny the fact that there's still investors who are making losses in the portfolio, and probably is in a mid to high single-digit losses. The fact is that if you look at the way we manage the portfolio, I mentioned, it's always based on fundamentals of the markets, based on the outlook of the markets for the next 2 to 3 years. But at the investor end, investors tend to make investment decisions based on the market sentiment, the market environment, and also their emotions. So that's why I also don't mind to share, for our products, for the managed portfolio, we get the highest inflow in 2021.
Because?
Especially early 2021.
That was good year.
Yeah, because if you think about it, we ended 2020 with a very strong performance, close to about 20% kind of a return for aggressive portfolio. So investors thought that, whoa, this kind of thing will repeat every year. That's why emotion is a key factor that affecting investors when it comes to making investment decisions. So if you think about it, where we have massive inflow in early of 2021, and throughout 2022, a huge drawdown, we don't deny the fact that there's still investors making losses. But the key important thing is that if you know the team that manage your money, their approach is disciplined and consistent across the years, and they really manage based on the fundamentals of the markets. And if this thing works for the past 5 to 7 years, for example, if you look at the 5 years annualized return, we are making about 7% for the aggressive portfolio. Given the fact that we experienced drawdown in 2022, given the fact that China is not performing for the past 3 years, Asia-Japan equity market is not performing for the past 3 years, the portfolio still make about 7% of annualized return for the past 5 years period. So I think the most important thing is that understand the products itself, understand your risk profile when it comes to making investment decisions. If it is a good thing, stay on with it, stay invested. I think like what you mentioned just now about timing the market and so on, I think those are one of the key factors that investors should really look into it. Because to be honest, even for us, we don't really time the market. I mean, if for some of our investment, our own personal investment, we try to time the market because we thought we are professionals. But I have to be very honest, for those that we have really tried to time the markets, ended up with losses. I mean, the most consistent and disciplined approach is really to stay invested across the years.
All right. So investors are paying you a fee to be actively managing them, to the portfolios. Define actively manage. How do you carry this active management words?
Yeah, I think everyone will have a different perception towards active. For a traders, active means every single second or every 10 seconds, that's active. What I mentioned, we manage it based on fundamentals, based on global macro outlooks. We don't try to make trades every single week or single month. For us, we always position ourselves based on a 3 years outlook. And on historical data perspective, we tend to make about 6 to 7 changes in a year rebalancing or portfolio changes along the year.
But that's not guaranteed, right? For
no.
sometimes.
It's always based on market environment and also the fundamentals of the markets.
All right, thank you. Now, coming back to the other podcast. Now, Tao Hong, you taught us intent. You taught us another word is leave it alone. Now, this is your third part. Any new words again? No. I wanted to ask you, what are the values that you are creating for the clients? I mean, that makes your platform so good to invest into OTC bonds. What have you done behind the scene? Share us.
When it comes to bonds investing,
New words.
I'm lots of words here, but I just want to draw some comparison to stocks trading, right? How easy it is to trade stocks today. It's pretty much it's on our fingertips, right? Everybody can trade stocks easily. But when it comes to bonds trading, have you ever thought about trading bonds as easy as trading stocks? Right? Not at this current juncture, correct? A lot of our investors are still buying and holding, right? Putting pocket money into their pockets. So as a platform, we have evolved through the years, right? OTC trading will become obsolete, right? Remember this today that I say that OTC trading will become obsolete.
Obsolete is the new word.
Just as, yes, obsolete is the word. Just as how stocks went through their own evolution, right? And when we take away OTC trading, you will be able to actively participate. Each and every one of you will be able to actively participate in the price discovery of bonds. Right? And that, I don't think, is a far-fetched thing. It could be a near future thing. But as a platform, if you ask me, how easy is this to get information for bonds? How easy is this to get information for stocks? Have you ever thought about that?
And unit trust funds.
Stocks, you can Google easily, right? But how about bonds? Have you ever searched for bonds information online and find it troubling to find information? So as a platform, right, we are providing those information for you on your fingertips. And that is the first step to all the things that I've just mentioned before, right? Until then, you will be able to get the information, digest the information, trade the bond. And there's one very special marketplace on our platform called Bond Express. A lot of us have experienced the power of Bond Express. At this moment, it is trading instantaneously, 24/7. Right? You can buy and sell bonds even midnight when you think about it. Right? The instantaneous part is even more powerful because it settles your bond instantly. Meaning, today, if you have cash in your cash account and you see available bonds on our shelf, you can use that cash account to transact, and you start earning your accrued interest today. You start earning your interest at the very moment you transact. And at the same time, if you decide to sell your bonds, when you click sell, the money is returned to your cash account instantaneously, and you can withdraw it to your bank account. So that is the power that I feel that FSM has empowered using the Bond Express platform, not only providing information, but also moving towards for you all to participate in the bond trading as easy as it's going to be trading stocks.
So 3 new words. Bond Express, number 1. Number 2, instantaneous. Number 3, 24/7. All right. Okay. Now, you have heard from Jerry. You have heard from Tao Hong. Then move on to your favorite boy. We have Kin On. Now, spot card number 2. I mean, IFRS or FSMOne is being the first ever broker to be approved by Bursa Malaysia and also Securities Commission in the past 13 years. What are the upper hands that your platform has right now for the clients?
Well, when SC and Bursa, approve us to be a participating organization, of a Bursa Malaysia, the vision for them is that for us to be an e-broking, e-broking simply means that it's fully online. Shouldn't be any traditional way of calling a remisier, having you to physically go to a platform or go to a company to do all the administrative work. They want to, empower all the retail investors, basically can do it anywhere, any place, as well as we have internet. So that's what, being appointed to us when the license is being approved to us. So I think our, mission and vision also align through that. So as of now, our vision is to have all the exchanges under one exchange, under one platform. That means that you don't have to have a, multi-login to get access to different exchanges. So all exchanges under one platform. And then also we have 24/7 FX live. That means that if the client invests in Hong Kong exchange, US exchange, they can instantly view what is a live exchange rate now. If the rate is okay, then the client can immediately transact. Yeah. Then I think another important point is that we are fully online account opening and corporate action handling. I think this is a big point because...
Do you charge for corporate action?
Unfortunately, no.
Unfortunately, no.
Yeah.
Very honest. Okay.
Yeah, I think the corporate action is a very painful process, especially I think some of our retail customers back then in the 1990s started off with a direct CDS account, right? It's a very painful process where you yourself have to run through, buying a stamp, 10 ringgit, then you need to courier it to the registrar office and do everything all by yourself, meeting the timeline, and maybe registrar office calling you, hey, Mr. Sorry, miss, you take the wrong place or you sign the wrong form, then you have to do it again. So whereas with FSMOne and IFAS, basically we handle everything for you, FOC, free of charge.
Every single good thing all in one place, 24/7.
Correct.
And it's free.
Yes.
No charges.
No charges.
All right, good.
Yeah. I think one last thing is I just also want to highlight is that when we started off this stocks and ETF platform on FSMOne, we built our front end, back end, basically all the system in-house. So as of now, we have a team of, I think, around 30 of them, basically maintaining, and also, if there's any hiccup on the system, they are always there to respond. So we have a team of 30 IT, helping us, supporting us. Yeah. So from that perspective also, with that 30, people supporting the stock business, we can continue to improve and introduce more features. For example, this year we have London Stock Exchange coming. We expect in first half, London is coming. Then regular saving plan also we open up for Singapore Stock Exchange as well as London. Yeah, so because in London there are certain Irish funds which without withholding tax as compared to the US ETF. Yep.
All right. Tao Hong, any new words? Just kidding, don't worry about it. Now, I think at the end of this panel discussions, I want to ask Jerry about it, to summarize everything that we just, even including Kevin, what he had just said about key investment teams, about what Tao Hong and Keon has shared as a portfolio manager. How would you combine it all together into a portfolio? And what is your advice to those clients who are still suffering probably 20-30% of investors' losses? Should they top up?
Okay, so I think basically, maybe to summarize on the first part on product perspective, also to share with everyone, if you all follow our managed portfolio closely, we actually started to include ETF into the portfolio. And we'll be increasing more of the ETF exposure slowly but surely, because for certain market, we really think that ETF will be able to add more value to the portfolio as a whole. So moving forward, we'll be getting more ETF exposure in the portfolio. And maybe to also sum up a little bit in terms of strategy for our portfolio in 2024, we will continue to overweight equities as what we have did in 2023. In terms of market allocation, we continue to overweight markets like Japan's, the technologies. We actually underweight China at this point in time. We actually increase our exposure towards Malaysia equity. So those are a pretty brief summary about our strategy. And in terms of advice to all the clients here, I think the most important thing is to really understand yourself, understand your risk profile. When it comes to investing, I think a very key lesson that I learned myself as well is really to set aside money that you can invest for a mid to long-term perspective, not to over-invest, not to overtake risk for your own portfolio, because things like China can happen to any other market as well. things happen to China for the past 3 years can repeat for other markets. Don't be overconfident when it comes to making investment decisions, because to be very honest, what's going to happen for the next 6 months, 12 months, no one really knows. What we have worked on is really on assumption and prediction. But no one will guarantee you the prediction and the assumption will always be right. You need to have your backup plan, set aside the money to invest for yourself, understand your risk profile, understand the risk that you can take for your portfolio. Don't put everything into tech. Don't put everything into China. These are not the right way to invest. Investing, the most important thing is about journey. People always focus on returns, focus on performance. But ultimately, what leads you to a successful investment journey or successful investment plan is really the journey along the way. A fund can make you 100% over 5 years, but you yourself couldn't suffer the 30% of losses, you will give up halfway. You wouldn't be able to enjoy the result. So those are really things that investors should take note. And most importantly, try to control your emotions, try to make decisions based on really fundamental factors instead of emotional factors.
All right, thank you so much. Now, Jerry also stepped out his game slowly but surely, ladies and gentlemen. Thank you so much for taking my questions, Tao Hong, Kin On, and Jerry. Ladies and gentlemen, give them a round of applause. Thank you so much for joining us today. Thank you so much.